Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris milling wheat and London, UK feed wheat.
Paris milling wheat. 22 weeks ago, part of my musings on the market were thus, and I quote, "We may have another bearish but less aggressively bearish pattern, though not necessarily by much. It's a mid-June to date bear channel, and currently 222 to 297, which is highlighted in bright green on my daily chart. I'm not saying either of these two will be the way forward, but if you favour the bearish side, then these are worth considering." End of quote. 3 weeks ago, the market created a cusp, and we had a break higher as the bearish pressure generated by the long defunct but pretty pitchfork gave way, and we have a resurgence higher, something I cautioned on 2 weeks ago. The market rose up through stratified layers of resistance. Some of them seemed and still seem quite dense, such as the congestion 238 to 242 that contains the March 2013 high at 240. The declining short medium moving average, currently 240 as well. The February 2013 high today at 247. Another congestion band between 250 to 255, with the 2013 high at 253 within it. The medium moving average also currently at 255 that declined into this area, then another small congestion area 258 to 260, with the 2011 high within it at 258, followed by a deserted area up to the most heavy looking congestion between 267 and 270, and that is enough to go on for now. Last week we still had the question open as to whether this move higher is just a recovery in an overly bearish market, or the attempt down in late August and early June to the 50% absolute Fibonacci line at 2019, and highlighted in purple on my daily chart. Whether this move down triggered the beginnings of a new bullish movement. Well, unfortunately, it is again still too early to say anything more than this is a bullish recovery. But I would keep a close eye on the moves higher just in case it becomes more, and by higher I mean if the market chooses to tackle the heavy looking congestion area between 267 into 270 and maybe starts to form a lip. You see, in many ways this daily chart has the makings of a better example of a descending scallop pattern than in the other grains. So hesitation for up to 15, maybe 20 even sessions could be the precursor to a much larger pattern. Much larger movement as well. London, UK feed wheat. Since the market exited up through the upper tine of a now defunct pitchfork, we have seen the construction of a small bullish pattern, a mini reverse head and shoulders pattern over a 3-week period, either side of the turn of the month from May into June. The resultant push higher has been over the 50% absolute Fibonacci line at 180.5, and this week over the flatlining short medium moving average, currently 184.80. The next major congestion overhead is now approaching in the form of the declining medium moving average, currently 200.55, and it would not be unreasonable to see both move towards each other. However, the bigger picture here is different when compared to other grain markets, and by this I specifically mean the chance of a possible descending scallop pattern, whilst still here, seems to be less. This may of course change with the market activity, but at this time we have just had a pullback higher from an overtly bearish market that has realistically been in operation since October last year. Additionally, we are far away from some of the moving averages, notably the long moving average, currently at 227.5, when compared to the other grain markets, which could indicate a number of different issues here in comparison to other markets. For example, a slower market development cycle when compared to the others. There may be factors that could subdue or even hide such ideas as a descending scallop pattern until much later. So where does that leave us now? Well, after pushing up through the short medium moving average and assuming prices maintain such a move, we have a fairly clear area topside up through lesser Fibonacci lines at 192.70 and 199.20. Up to the declining medium moving average, which is just ahead of the first real piece of stratified resistance banding we can see overhead. This is between the March 2013 high at 205.05 and the 2022 low at 206.5. By then we may well know whether this market is like some of the other weak markets and form the beginnings of a possible descending scallop pattern. But it is still a bit of a move higher. The market needs to construct to get up to those levels. It's still not there at the moment.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.